Greece's conservative and pro-bailout New Democracy Party, led by Antonis Samaras, has edged to an election victory over the radical left Syriza party. The result has eased fears of a sudden Greek exit from the euro. But as Mr Samaras seeks to form a broad coalition, there are still concerns he can deliver the stable government the country needs.
It's likely that he will go into government with PASOK, the kind of rump of the old Socialist Party, which now are down to only about 12.9%. But with them and then another left-wing party, he should be able to get a working majority. But I think he knows that unless he can revive the economy and give Greeks some sort of long-term perspective as to how their country is going to get out of this, then he's always vulnerable to further radicalisation of politics. And just tossing up the votes in this election, something like over 50% of Greeks voted, about 55% of Greeks voted for either far left or far right parties.
The markets initially rallied after the news of the election results in Greece, but the change in sentiment was short-lived.
We saw equities spiking higher, we saw treasury yields dipping down as people moved their money out of havens, gold fell back, and the euro rose very sharply. But since the European session started, people are a little bit more circumspect about this. They realise a number of things. Firstly, they realise they have to agree a coalition in Athens. That coalition then has to stay in place for quite a while. And it's also the fact that they may go and try and renegotiate some elements of the bailout deal with the Troika, the EU, the IMF and the ECB.
I think that there is a realisation in Berlin and Brussels that the way that the bailout package is being structured just isn't working for Greece. They're in a kind of downward spiral. What I think the Germans will be reluctant to do is to throw even more money at Greece, because that will be very unpopular at home, and also they're conscious that Spain and Italy are knocking on the door. And they will be very reluctant to say that Greece can ease off on the kind of structural reforms, which I think everybody recognises are necessary to kind of create the conditions for entrepreneurship. Where there might be some wiggle room is to say to the Greeks, well, look, we'll lengthen the terms of payback.
The worst case scenario as far as the markets are concerned has been averted. They were terrified at the prospect of Syriza winning the election. The man they wanted won. But this result hasn't resolved the underlying problems facing the Eurozone. For now, all eyes are on Spain.
We had some data out today which showed that bank loans in Spain, the ratio of bad loans is at an 18-year high. This has caused Spanish yields, 10-year yields, to burst back above 7%, a level deemed completely unsustainable for Madrid's financing needs.
I think that in retrospect, the most significant event of the last week in the Eurozone crisis may not even be the Greek elections. It was probably the bailout for the Spanish banks, which took place the previous weekend and which failed to really lower Spanish bond yields and made it clear that, you know, this 100 billion they were throwing at the Spanish banks might not be enough to save the country, and therefore we're looking at much bigger sums, and that really is worrying for people.
The Greek election has delivered the result that EU leaders in the markets were craving, but Mr Samaras hasn't even finished the difficult job of forming a coalition government yet, and there's already a lack of confidence in the markets. Concerns about stability in Greece remain, and the spike in Spanish bond yields are a timely reminder that this is a pan-European crisis. Daniel Garrahan, Financial Times.